Starbucks has just had its Q4 earnings. I'm going to briefly go through some of the highlights. Both revenue and earnings beat expectations, sending the stock up over 7% in pre-market hours on Thursday. Earnings per share beat $1.06 versus 97 cents expected. Revenue up $9.37 billion versus $9.29 expected. The company's same-store sales rose 8%. Legions of dedicated fans flocked to pick up the seasonal pumpkin spice latte. It's become synonymous with Halloween. Even I'm partial to pick up one, and I'm all about super strength black coffee to fuel the day. The company opened 816 net new stores in Q4, ending the period with 38,038 stores. Outside of North America, same-store sales increased 5%, driven entirely by more customer visits. And in China, Starbucks' second largest market, same-store sales rose by 5% as well. A year ago, same-store sales in China plunged 16% as a result of China's government zero COVID policy, so it really has bounced back since then. Starbucks stock price is pretty much where it was a year ago. It's nice to finally have some good news after the union strikes and extended COVID issues in China. Starbucks has a dividend yield of 2.5%, which is relatively high as the average yield has been 2.05%. Compound annual growth rate over the trailing 12 months has been 7.55%, 8.21% over 3 years and 9.65% over 5 years. I expect this to be much stronger going forward after all these headwinds have subsided. The payout ratio is 65.49%, easily sustainable, especially considering the average of previous years. It's had 13 years of consecutive dividend increases as well, which as a dividend investor is exactly what you want to see. Another metric I like to look at is how it's performed against the S&P 500. Past performance doesn't guarantee future performance, but if it has a strong track record and a focused strategy where you can see the company progressing, then it helps give you an idea of future growth. If you'd invested $10,000 10 years ago and reinvested the dividends, you would have had a total return of 172.49%, ending with a value investment of $27,254.18. A great return that almost matches the S&P. The S&P would have been 188.03% return with $28,796.93. So it stands up solidly against it. Let's see what the analysts are forecasting. Market beat have an average price target of $113.68, 24.45% upside from where we are today based on 21 analysts. Tip ranks have an average price target of $107.25, 17.41% upside from where we are today based on 16, and SBUX have an average buy price of $110.64, 21.12% upside from where we are today based on 22. Decent targets from all three. An average between market beat, tip ranks and SBUX is $110.52. Then if we have a look at value investing for the intrinsic calculations based on the discounted cash flow model, it has a fair price of $137.38, which is 50.4% upside. Then if we have a look at trading multiples, it has a fair price of $83.20, which is 8.9% downside. And finally, the Peter Lynch formula, which is earnings growth times trailing 12 months EPS, earnings per share, sees it have a fair price of $85.58, which is 9.6% downside. If we take the average of the analyst expectations and the investing models, that would give us an average price target of $104.17. With a 10% margin of safety, that would give us a buy price of $93.75. And a little bit overly cautious at 20% margin would be $83.33. I'm a shareholder, and personally I would be happy picking it up at $90. Anything below is a bonus. As usual, thanks for watching. If you've enjoyed the video, please like and subscribe.